prices rose as the U.S. cut its forecast for a global oversupply as the Energy Information Administration slashed its prediction for a surplus this year and reduced its outlook for a surplus in 2026, citing the prospect of diminished flows from Iran and also Venezuela. Despite the rise in prices, overall sentiment remains fragile due to tariff developments, concerns over U.S. growth, and geopolitical concerns including the Ukraine-Russian conflict and tensions in Yemen. Tuesday after the close, the American Petroleum Institute reported a build of 4.24 million barrels in U.S. commercial crude inventories last week. Additionally, the EIA inventory data showed a build of 1.4 million barrels following last week's build of 3.6 million barrels. Now, the U.S. Energy Information Agency on Tuesday boosted its forecast for the 2025 benchmark Henry Hub natural gas spot price by 11% from last month's forecast following a cold February. The average price is now seen at $4.20 per million British thermal units. In its March short-term outlook, the EIA said the increase, which is expected to extend into 2026, will be driven by higher natural gas consumption and lower natural gas inventories. The inventory data has shown smaller than expected drawdowns over the last few weeks, and tomorrow's inventory report is expected to show a drawdown of 48 billion cubic feet versus last week's 80 billion cubic feet, continuing to show a trend towards more of a neutral stance as far as builds and injections as we come into the spring and summer months.